Adesoji, let's just pick up on the performance of the sector yesterday. Only 3 gainers, yet the market managing to close on a positive note. From your side, what are your views on the type of activity that we've seen so far in banking stocks this week?
Morning, Samantha. The Nigerian market as a whole, it's been topsy-turvy this week. I think what's really been happening is we're seeing the sellers are really domestic long onlys, and we're seeing buy-side orders from a lot of the foreign monies. So whether it's hedges, whether it's dedicated African money, you're really seeing demand coming in from this, from this bouquet of clients. So it's really been a mixed bag. And what's happening is the domestic long onlys are selling, pretty much a bunch of the consumers and also the banking names, whilst the foreign clients are picking up a lot of these names. So it's a mixed bag, but broadly speaking, we're seeing an increase in value traded. I think yesterday we had about $34 million traded versus the $5 to $10 million we saw being traded on average towards the end of last year. So there's been a ramp up in value traded this year, indicating decent demand volumes for Nigerian equities as a whole.
In the meantime, let's just check in on some news flow around some of the banking sector stocks. Zenith, of course, is still on Rencap's buy list and hosting a conference call yesterday. From your side, what were the key areas that management was able to clarify for Rencap?
Okay, sorry, I didn't get your eventual question. What did you say? In
terms of the conference call that Zenith hosted yesterday, what were the key areas that management provided greater clarity on?
Oh, okay. The biggest area where investors had questions on was on the impairment charges through the P&L. Because if you look at what management had provided all through 9 months 11, they had just 7 billion through the P&L. In the last quarter, there was an increase of to 17 billion, cumulative of 24 billion for the year. So the key clarity which investors were seeking was where exactly did this 17 billion come from, and why didn't you take it through the previous quarters of the year? Breaking it down, 17 billion, 11 billion of that was general provisions. That's 1% of the performing loans and an additional provisioning for other risk assets. There was 5 billion for their Zenith sale, 10% haircut, which we expected. And there was about 2 billion from subsidiaries. Essentially, I think the key area where we had concern was the fact that all of this came through in Q4 versus having to have spread it out over the previous quarters of the year. That notwithstanding, the other key thing is the 24 billion itself does not necessarily indicate that Zenith Bank's loan book has materially deteriorated, because about 45% of that, that figure we're talking about is general provisions. And this is just a blanket cover for your risk assets, just in case they deteriorate to an extent. And under IFRS, there's potential for this to actually be written back. So for us, we are still very comfortable with Zenith Bank overall. We still have a buy rating on the stock.
Sorry, how much more provisioning is said to come through in 2012?
The provisioning is likely to come down. And like I said, 45% of what we saw come through in 2011 was general provisioning. So this really should not be an area of concern or a clear indication of what's likely to come in the future. And another thing to highlight is general provisions came on the board. The base effect came through in 2011, really because in 2010, we didn't have general provisions at all. So the 10 billion huge sum came in 2011, and if we're still to be reporting on that gap going forward, what you'll be seeing is just the incremental provisioning from the increase in the loan book, which will be significantly lower than 10 billion. So it's really not an area of concern, and the outlook for impairment charges for this to tick downwards going forward.
Looking at your note on Zenith, you're looking at 26% loan growth this year and 18% deposit growth. Can you give us an idea of whether management will be able to reach those targets that you're highlighting?
The interesting thing with Zenith Bank growth last year, let me even look at 2011. On the face of it, they delivered 17% credit growth. However, the underlying credit growth in those figures was phenomenal. They actually delivered about 25% if you factor in loan sales to AMCON. So that is very strong in a year where many of the banks were still delivering loan growth that wasn't anything so fantastic. So going into 2012, we're already seeing month-on-month credit growth of 3% in January. So if you analyze that, that's giving about 36%. We are forecasting 25 to 30% for the sector, 26% for Zenith Bank. We are still very comfortable that Zenith Bank can actually do 26%. The sectors which we expect to drive this include telecoms. There's a lot of service upgrades happening in that space. Telecoms, manufacturing, food and bev. If the reforms happen, you see decent credit growth happening in power, infrastructure and agric as well.
What about the fact that Zenith came out saying that ROE is expected to be 15% this year? That's lower than the ROE that you were looking at 17%. We know they have a high capital base, but is this a cause for concern, the fact that return on equity is a lot lower than some of the other top tier banks?
I think the return on equity isn't actually lower than a lot of the top tier banks. In fact, in our view, the only bank which we think will consistently deliver above Zenith Bank going forward is actually GTB. And if GTB is the bride in the sector, we actually think Zenith Bank is the the maid of honor. So Zenith Bank expecting 15%, we think that's conservative. Our forecast still stays at 17%. We think they can actually deliver 17% for 2012. Impairment charges was the key drag in 2011, and like I said already, that was really the base effect of general provision, in which under IFRS is likely to reduce. So 17%, we stick with that, and we think 15% is conservative for 2012.
So based on all these analysis, you're basically looking at a stock which is poised for growth. You're looking at 44% upside potential in the stock. Are you still targeting a price of fair valuation, rather, of around 18 Naira?
Yes, the fair value is intact. At this point, we haven't changed our models yet, so we still have 18 Naira in there. If you look at the key lines of the P&L, NIMs likely to be flat to rising in 2012. Non-interest revenue, we expect that to continue to witness decent growth. In 2011, the non-interest yield improved from 3.3 to 3.7%, which is decent in our view. Impairment charges, we expect that to to tick downwards. On the cost front, we expect cost-income ratio to improve as revenues improve. The last thing will be on the tax front, which came as a surprise in 2011. But I think if analysts, should I say, build their models in line with a 25% tax rate, I think the surprises that came through in Q4, will not be a surprise in 2012. So from that viewpoint, we're still very comfortable with our target price, and we retain our buy rating on the stock at 18 Naira per share.